What are the factors that is influencing the dividend policy? So what is the factors? Internal factors and external factors. So that is very important for your examination. When all the 5 dividend percentage is given, we are calculating the rate of return 12%. So using 12%, first one, we are calculating dividend for all the 5%. When the rate of return is 15%, your earnings will be 8 rupees, cost of equity capitalization rate is 10%. Hello everybody, I'm Divya, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. I take this opportunity to welcome you all for your Unit 3 on your Session 1, that is your dividend decision. Moving forward, the topic for today's discussion, dividend decision, concepts and problems. So before getting into problems directly, let us understand what is dividend decision is all about, what is dividend policy, and what are the different types of dividend that the company issues in order to retain their shareholders. So all these things we'll discuss, and what are the different types of theories we have, all those things we'll discuss, and then move on to the practical problems. So what is dividend decision is all about? So before understanding the problem, you have to know what is dividend decision. So dividend decision is all about taking the decision regarding whether the company should retain the profit whatever it has earned, or it has to give the dividend to the shareholders. So what is the dividend? Dividend is nothing but the return the shareholders get for investing in the company. So what is dividend? Dividend is nothing but the return the shareholders get for investing in the company. So company, the firm earns the profit. So in that part of the profit, whether they have to issue it as a dividend or it has to retain a profit as a retained earnings in order to invest in the next upcoming year. So what is the decision they have to take? So this chapter explain you all regarding what is the decision they have to take. So dividend decision is the major decision the financial manager or a company should take, because it is all about investment decision. So whatever the return they get, the return either they have to distribute as a dividend or they have to retain as a retained earnings for the next upcoming investment. So that is all about dividend decisions. So in this chapter, you will be learning one terminology called as dividend policy. So what is this dividend policy? So in your article of association or the memorandum of association, the company fixes a policy. So what is that policy? Policy is nothing but rules and regulation with respect to issuing of dividend. So what amount of dividend they have to issue, what portion of dividend they have to issue. So that is called as dividend policy. So dividend policy is nothing but the company's policy or the firm's policy. So in order to take up the decision regarding what portion of profit has to be issued as a dividend and what portion of or what amount that has to be retained by the company itself. So in dividend decision, we have 2 types of dividend that will be issued. One is stable dividend, the other is unstable dividend. So stable dividend, it is nothing but the company issues the dividend on a year basis. So there will be stability in issuing the dividend. So that is what the shareholders expect from the company, because it is very important to issue a stable dividend. So if the dividend is issued, again the shareholders will come and reinvest in your company. So that is stable dividend. And the other is unstable dividend. So where the firm chooses not to issue the dividend on a frequent basis. So So every year they won't issue the dividend. So it will be unstable. So stable dividend and unstable dividend. So always the shareholders prefer for stable dividend. So, and the one more topic that has to be learned by you people in this dividend policy is determinants of dividend policy. What are the factors that is influencing the dividend policy? So what is the factors? Internal factors and external factors. So that is very important for your examination. So many experts have given the various theories regarding the dividend decision. So what are those theories? It is nothing but it has been bifurcated into two things. Dividend decision is bifurcated into two parts. One is relevance theory, the other is irrelevance theory. So experts have given the relevance theory as well as irrelevance theory. So how the dividend policy, dividend decision will affect the value of the firm. So that is your dividend relevance theory. So there is no relationship between the dividend decision or the value of the firm. So that is irrelevance theory. So relevance theory and irrelevance theory. So experts have given relevant approach as well as irrelevance approach through their theory based on certain assumptions. So few of them are Walter's model, Gordon's model, and the other is Modigliani-Miller approach. So what is first one? The first one is Walter's model. The other is Gordon's model. Theory of irrelevance approach is Modigliani-Miller approach. So MM approach. So it is irrelevant to the decision. So whatever the firm that they decide to issue the dividend, that dividend, whatever the company wanted to issue, so that doesn't affect the value of the firm. So let us discuss all the theories one by one. So in today's class, we'll be discussing the first theory, that is your Walton's model relevance approach. So what it says, what is Walton's model? So why the word Walton's model is there? Walton's is a name of a person. It's a professor name. So Professor J.E. Walton's, Professor James E. Walton has given the model, that is your Walter's model. So he has advised that. So what was his explanation about the theory? So he explains that the dividend decision as well as the value of the firm has a direct relationship. So keeping two things in mind. One is the return. What is this? R stands for internal rate of return. And what does this stands for? K subscript with E, that is your equity capitalization rate or the cost of capital, cost of equity. So keeping these two things, he explains the relationship between the value of the firm as well as how it affects, how dividend decision affects the value of the firm. So what this theory suggests? It suggests that so there is a relationship between the value of the firm and the dividend decision. So what he explains, when return is greater than the cost of capital, so this situation where the firm exists, that firm is called growth firm. So what it is? It is growth firm. So when the company, when the firm's rate of return, when the profit is more than the cost of capital, then that firm is what? Growth firm. So when the company is in growth firm, so the theory suggests to issue 0% dividend, because the company, the firm will have a better investment opportunity in investing than the shareholders' investment. So keeping this in mind, so they explain things when the return is more than the cost of capital, so the company, the firm should use 0% dividend. So the company should retain all the profits within the company itself. It has to retain, because the firm will find a better investment opportunity than the shareholders investing. The other situation is when the return is lesser than the cost, the firm has to issue 100% dividend. So what the firm has to do? The firm has to, whatever the returns they get, everything they have to issue it as a dividend, because the shareholders will reinvest in the company. So when the return is lesser than our cost of capital, the company has to what? They have to issue the dividend 100%. And the other situation is when the return is equal to cost of capital or the cost of equity. So what the organization, how the firm has to do? It has to, the price of the market share will not affect the dividend decision, or the dividend decision, the price of dividend issuing will not affect the value of the firm. So here in this case, it might be the dividend payout ratio might be 0% or it might be 100% as per the company situation, because the retained earnings is equal to your cost of capital. So firm doesn't have any effect on the dividend policy that has been taken by the company. So this is explained by J.E. Walton's, that is your Walton's model. So what he says, it is a relevance approach. In that relevance approach, so he explains about the relationship between the dividend policy. So he explains, so there is a effect on the valuation of the firm based on the dividend policy, dividend decision taken. So in these three cases, he has explained how the company will pay the dividend. So when the R is greater than the cost of capital, the firm should use 0% payout ratio, and when the R is lesser, when the return is lesser than the cost of capital, the organization, the firm should pay 100% dividend. And when R is equal to your cost of capital, that is your, the company might pay 0% or it 100%. So there is no effect on the dividend decision as well as valuation of the firm. So this is explained through the different assumptions. So assuming the assumptions, they have given this theory. So based on this theory, 15 marks questions will be asked in your examination. So based on Walton's model, so you have to calculate the market price of the share by using Walton's model. So let us look into the first problem. Problem number 1, the following information is available in respect of the firm where cost of equity is 10%. So what is cost of equity? 10%. So that will be 0.10. So rupees earning per share is rupees 50. Rate of return is 12%, 8% and 10%. Show the effect of the dividend policy on market price of share applying Walton's approach when dividend is 0%, 20%, 40%, 80% and 100%. So before that, let us discuss what is the formula of your Walton's model. So the formula of Walton's model here, market price. What P stands for? Market price per share. What is D stands for? Dividend. R, rate of return, internal rate of return. Earnings minus dividend, or it is also called as retention rate of a particular share. That is your K subscript with E, it is called as cost of equity or equity capitalization rate. So this is the formula to calculate your Walton's model. So what is given in the question? Dividend, they have given in the percentage. So how the dividend will be calculated? Based on the company's earnings. So what is earnings given in the question? Earnings is rupees 50. So on rupees 50, when they issue 0%, what will be the dividend per share? Then if they issue 20%, what is the dividend per share? And 40%, 80% and 100%, for everything we have to calculate on earning per share. So earning per share into 0%, earning per share into 20%. So we have to do it and calculate the dividend. So this cost of equity, 10% it is 0.10. You can take it as that. Then you have return, that is given 12% and 8% and 10%. So when the return is 12%, what is the dividend you have to issue? What is the rate of return we have? When the return is 8%, what is the dividend? When the return is 10%, what is the dividend? And what is the market price per share? Has to be calculated using Walter's model. So let us take up all the cases one by one. So what is the first case? When the return is 12% and the dividend is 0%, 20%, 40%, 80% and 100%. So let us calculate the dividend per share first. So what is the earnings? Earnings is 50 rupees. 50 into 0%, it will be how much? It will be 0. So your dividend will be 0. So we are calculating for the first case when the rate of return is 12% and the dividend is 0%, 20%, 40%, 80% and 100%. For all the 5 cases, when all the 5 dividend percentage is given, we are calculating the rate of return 12%. So using 12% first one, we are calculating dividend for all the 5%. First percent is what? 0% when the rate of return is 12%. So let us substitute the value to the formula and check out. So 0 plus 12% rate of return 0.12 divided by what is the cost of equity? That is your equity capitalization rate 10%, 0.10. So earnings is 50 minus 0. If you substitute the value, your answer you get is rupees 600. So how do you calculate that? 0.12 divided by 0.10 into 50 plus 0 whole divided by 0.10. The answer you get is rupees 600. Moving forward, next we'll calculate for 0% we have calculated. Now we have to calculate when the rate of return is 12%, we are calculating for 20%. So when the rate of return is how much? When the rate of return is your how many percent? 12%, we are calculating 20% dividend. So what is earnings? Earnings is how much? 50 rupees. 50 rupees into what is the dividend percentage? 20%. So 50 into 20%, it is 10 rupees. So how much it is? Dividend is 10 rupees. So we are calculating what? When return is how much? Return is 12%, dividend is 20%. We are calculating that. Dividend. Next, as per your formula, return is 12%, 0.12 divided by your cost of equity 0.10 whole divided by 0.10. Earnings is 50 minus dividend is 10 rupees. So if you substitute the value, you get the answer 580. Next, we are keeping the same rate. That is, your rate of return is 12%. Now we are calculating the dividend for 40%. So with the same, when the R is 12%, we are calculating dividend 0%, 20%, 40%. So 40%, 50 rupees into 40%, it will be 20 rupees. 20 plus your rate of return divided by equity capitalization rate minus earnings 50 minus your dividend. If you substitute the value, you get 560. Moving forward, we are calculating for 80%. So what is earnings? Earnings is 50 rupees into 80%. 50 rupees into 80%, it will be how many rupees? It will be 40 rupees. So what is the dividend? Now 40 rupees is the dividend per share. Rate of return is 0.12 divided by 0.10. 50 minus 40. 50 is your earnings minus your dividend. 40 whole divided by 0.10. You get the Answer as 520. So we have to calculate for everything. So rate of return as well as your dividend. So when the rate of return is 12%, dividend is calculated for 0%, 20%, 40% and your 80% and 100%. So 100% dividend, the value with the dividend per share you get is 50 rupees. The rate of return is 0.12 divided by the equity capitalization rate 0.10, 50 minus 50, earnings minus dividend divided by 0.10. If you calculate, the answer you get is 500. So this is what, when the return is 12%, dividend is 0%, 20%, 40%, 80% and 100%. Moving forward, we have another rate of return is given in the question. So what is the another rate of return? It is how much? 8%. So 8% is the rate of return given in the question. So next is 8% when it is 0.08. 8%, dividend is 0%, 20%, 40%, 80% and 100%. So you have got the dividend per share amount value. So in the first case, when the dividend payout ratio is 0%, the dividend per share also will be 0 only. And when the dividend per share is how much? 20%, dividend per share will be how much? It is 10 rupees. So this we have calculated 0, 10, 20, 40 and 50. We have calculated for the first case, that is R is equal to 12%. The same dividend we are taking, only the changes we are doing here is R is, the return is 0.08. So dividend rate of return divided by equity capitalization rate whole divided by 0.10, that is your equity capitalization rate, earnings minus 0, the value you get is 400. Next case, we have 20% as a dividend. So earning per share, that is your dividend per share will be how much? 10 rupees. Dividend, your return is how much? 0.08 divided by equity capitalization rate whole divided by equity capitalization rate. 50 minus 10, earnings minus dividend as per the formula. If you substitute the value, the answer you get is 420. Moving forward, we are calculating for the rate of return is 8%, but the dividend percentage is how much? 40%. So dividend per share will be how many rupees? 20 rupees. Rate of return will be 0.08 divided by equity capitalization rate whole divided by equity capitalization rate, earnings minus dividend. If you substitute the value, you get 440. Moving forward, we are taking it for 80%. So 80% dividend. What will be the dividend per share? It will be 40 rupees. 40 rupees. Return is 0.08 divided by 0.10 is your equity capitalization rate whole divided by 0.08. 50 minus 40, that is your earnings minus dividend, you get 480. Moving forward, we are doing it for 100%. 100% is the dividend payout ratio. Dividend per share is 50 rupees is the dividend per share. So 0.08 is what? 0.08 is the return. 0.10 is your equity capitalization rate. Then earnings minus dividend whole divided by 0.10, the answer you get is 500. So moving forward, we have done for the return 0.08. One more rate of return is given in the question. What is that? It is 10%. So when the rate of return is 10%, the dividend payout ratio 0%, 20%, 40%, 80% and 100%. And what will be the market price of the particular share? You need to calculate for your rate of return 10%. Moving forward, rate of return is 10%. Your answer will be for 0%, 20%, 40%, 80% and 100% is the dividend payout ratio. So when the dividend payout ratio is 0, the dividend per share also will be 0. When the dividend payout ratio is 20. Dividend per share will be 10 rupees. 20 rupees when it is 40%, 40 rupees when it is 80%, 50 rupees when it is 100%. The same calculation we are retaining back. The only changes we are taking up into the formula is your rate of return. That is your how many rupees? That is your 10% is the rate of return. So 10%, 0.10. If you calculate the market price per share will be for all the percentage, for all the dividend payout ratio, it will be 500, 500, 500, 500 and 500. So this is how you calculate your under your Walters model. So this is 15 marks compulsory question in your examination. So Walters model is very important. So what is the formula of Walters model? Dividend plus return, that is your internal rate of return, divided by cost of equity, whole divided by cost of equity, that is your earnings minus dividend. So this is your formula for your Walters model. So always keep that formula in your mind while calculating the Walters model. So under Walters model, the different rate of return will be given for different dividend payout ratio. So you need to calculate the market price of the particular share for all the dividend payout ratio percentages given when the rate of return varies. So from this problem, we have to conclude the conclusion part by interpreting the problem. So what we have to do, what we have learned, so it was explaining the relationship between return and your cost of capital. So when the cost of capital, when the return is more than the cost of capital, the firm is assumed as a growth firm. So what they need to do, they need to pay 0% dividend. So what is the return? When the return is 12% and the cost of equity is 10%, so which is more? Return is 12%, cost of equity is 10%. In that case, when the return is how much? 12% and the cost of equity is 10%, the firm has to issue the firm has to retain all the earnings. It has to follow 0% dividend payout ratio. And the second case, the rate of return is lesser than the cost of equity. The firm has to do what? It has to pay 100% dividend. And in the third case, when the return and the cost of equity is equal, the firm has no effect with the market price of the share. So this is how you have to interpret in your problem. This is 15 marks problem. For your more clarity on the problem, so let us take up one more problem on Walters model and understand in a better way. So the only thing calculation you have to do in your Walters model is first understand the formula and then start substituting the values on the formula. So how to calculate the earnings, how to calculate the dividend per share, dividend payout ratio will be given in a percentage. You have to convert it into dividend per share. How to calculate earnings into dividend payout ratio. So you will get the dividend per share answer. Moving forward, we have problem number 2. So let us read the question. Following information is regarding 3 companies, A, B, C company. In the particulars, they have given return. So 3 rate of returns, 3 different rate of returns is given in the question. 15%, 5%, 10%. Cost of equity 10%, 10%, 10%. So 10% it is how much? 0.10. 0.10. So earnings is given 8 rupees is the earnings. Calculate the value of equity shares of this company by using Walters formula when the dividend payout ratio is 50%, 75%, 25% and draw your conclusion. So what is 50%? 50%, 75%, 25% when your earnings is 8 rupees. So the formula will be same. So let us calculate. When the rate of return is 15%, your earnings will be 8 rupees, cost of equity capitalization rate is 10%. So how do you calculate now? First, you need to calculate dividend per share. So how do you calculate dividend per share? When the earnings is 8 rupees, dividend is how much? Dividend payout ratio is 50 rupees into 50%. So the earnings is 8 rupees, dividend payout ratio is 50%. The earning per share is 4 rupees. Next, 75%, the dividend per share is how much? 6 rupees. When the dividend payout ratio is 25%, the dividend per share is 2 rupees. So first you need to calculate the dividend per share value, and next you have to calculate the next step is to calculate the returns, and from the different returns you have to calculate the dividend. First case, when the return is 15%, dividend payout ratio 50%, 75% and your 25%. So how do you calculate? By applying Walter's formula. So your dividend per share value is known to you people, 4 plus this is what? Your rate of return 15% divided by equity capitalization rate or cost of equity whole divided by 0.10, that is your equity capitalization rate, earnings minus dividend. So if you substitute the value, you get how much? 100 rupees. So what is this? Market price per share. Next, moving forward, when the dividend is 75% and the return is 15%, what will be the value? It will be 70%. 70 rupees, that is your market price per share. Moving forward, when the dividend is 25%, when the return is 15%, so what will be the market price per share? It is 110. So how do you calculate this? First you need to calculate the dividend. So dividend per share plus return divided by cost of capital or equity capitalization rate whole divided by equity capitalization rate, earnings minus dividend. So if you do this, if you substitute the formula by using a calculator, you will get the answer, that is your market price per share. So next is the second case is all about 10% rate of return. When the rate of return is 10%, when the dividend payout ratio 50%, 75%, 25%, what will be the answer? So 10% rate of return, your dividend per share 4 rupees, 6 rupees and 2 rupees. We have taken that. All the values as per the formula. If we substitute, the answer you get is 80, 80, 80 rupees. One more rate of return is there. What is the another rate of return we have? It is 15%, 10% is done, 5%. It's a homework for you, my dear students. Kindly solve the problem when the rate of return is 5%, dividend payout ratio is 50%, 75% and 25%, and put the answers in a comment section. So, and check out the answers for yourself. So let's conclude this problem. So what is the conclusion that we can find? So when the A Limited, this company is growth firm. So A Limited, this company, A Limited company is a growth firm. So why it is growth firm? Why? I have explained you, my dear students, with the Walter's model. So what is that growth firm? When the rate of return is greater than the cost of equity, so then the company will be what? It will be a growth firm. So here the rate of return is how much? 15%. The cost of equity or the cost of capital is how much? 10%. So 15% is greater than 10%. So that is why A firm is assumed as what? A growth firm. Moving forward, this company is a growth firm. The rate of return is higher than the cost of capital. That is why that 15% is more than the 10%. It is better to retain the earnings of a company rather than distributing the dividend for maximizing the equity shareholders, in order to maintain a equity shareholders in our organization, because they reinvest. If the dividend is stable, their earnings is stable, the shareholders will come and reinvest in our company. So this is the decision that the dividend, by issuing the dividend using a Walters formula, they can take. So in the current situation also, the firms use a Walters formula in Walters model in order to maintain a market price in the firm. In order to retain the shareholders, they use Walters method, the relevance method of dividend decision, in order to take up the decisions regarding the dividend, issuing the dividend or retaining the earnings. So that's it, my dear students. Thank you so much for joining today's class. Hope the session was very interesting, fruitful, and you people have learned the problem, 15 marks problem. So keep practicing the problems. So smile is the biggest jewel you can wear. Keep smiling, people. Thank you.